Hey everybody, this is James with wstrades.com. Wanted to make a video here and just kind of talk about some basics when it comes to trading put options. I recently made a video just talking about call options and kind of the basics of how they work, how you can be profitable on them, how you can lose money on them. So I wanted to go over puts here, and I'm going to use my favorite ticker here. In this example, it's going to be SPACE or Virgin Galactic. They are selling off a little bit here. They just dipped under the $24 mark, but let's just say they are still right around this $25 mark right now, which is pretty much where they've been trading at for quite a while now. They've been consolidating and going real sideways. So let's just say this is the chart of SPACE, or this is the price action of SPACE, and it's around this $25 mark here. I've got a put option contract up here on the screen of a 20 strike. It shows it's a put, and the expiration is November 19th, 2021. So kind of how the put option contract works here. You have three major components to the put option contract. You've got a strike price, which is $20 here. You've got the type of contract, which we're looking at the put right now. Then you've got the expiration, which is November 19th, 2021. So the way this put option contract is going to work, whether you're buying or selling, is you are agreeing to either buy if you're going long this contract, or if you're going to sell and be short this contract, you're agreeing to be able to sell shares or buy shares at a particular price on a particular date. So the particular price we're talking about here is this strike price of $20. So that is the agreed upon price to exchange shares on SPACE on November 19th, 2021. So just say SPACE is trading around $25 right now. Let's just say I want to buy this contract. I'm going to say that there's some more bad news coming out on SPACE. They're still going to struggle to continue their test flights and stuff, and moving towards taking private citizens to space. So let's just say I think SPACE is going to tank and go down to like $15. I might come here and buy this 20 put for November 19th. Let's just say I think that's going to happen, within the next couple of months. So I'm going to go out here and buy this contract here. So let's pull up the options chain. If I go in Thinkorswim and I go to the trade tab, I've got SPACE already pulled up here. I hit trade. I have the options chain here. I expand out this November 19th expiration. My puts are existing here on the right side of the screen. My calls are on the left. So I'm going to focus in on the right side here. As you can see, these are the puts. And here is the 20 strike for November 19th. So you can see the bid here is 107 and the ask is 110. So if I wanted to get filled here at a mid price, I'm probably going to pay $1.08 or $1.09, which in reality is $108 or $109, because each options contract controls 100 shares of the underlying stock. So whenever you see this price here, it says $1.07 or $1.11, it's truly 100 times that. So if I wanted to buy this 20 put here and I think SPACE is going down, I'm going to fork over a little over $100 to be long this contract. So let's take a look here, and how is this going to work out for me as a buyer of this contract. So let's say I purchase this thing, I cough up the $100, and let's say I'm wrong on my assumption, and let's say SPACE does not go below $20 by November 19th, or let's say it doesn't make any move to the downside at all. November 19th rolls around, I'm long this put contract, but it's going to be worthless come November 19th if SPACE doesn't dive below $20. Because think about what the contract says. If I'm long this contract, I have the right to put shares to somebody or sell shares to somebody for $20. If SPACE is trading at $25 come November 19th, that's not going to make any sense for me to try to sell SPACE at $20 when it's actually at $25. So you can see why this contract is going to be worthless for the buyer of the contract, or if I'm long this contract. Now let's say I'm right, and let's say SPACE tanks and goes down to $15. So let's just say, Space is trading at 15 bucks come November 19th. So let's just say it went way down there. You can see the difference here between the prices here. You have a strike price of 20, you have an actual share price of 15. There's a $5 difference between those two, and the contract controls 100 shares. So you can see that this contract on November 19th at expiration is going to be worth 500 bucks. You have a $5 difference times 100 shares, $500. This contract will actually be worth $500 at expiration. Now, you don't always have to hold your contracts through to expiration. If the stock price makes a big move in your favor ahead of expiration, you can just sell the contract, or you can wait until expiration happens and you'll actually be selling the shares of Space at the strike price. So if you just let this go through, it's in the money. Brokers are typically going to exercise this contract for you, and you're going to dump your shares. So Space is only really worth $15, but you hold this 20 strike put, so you're going to be able to put shares to a seller of this contract and realize your profit. So let's go to the seller side of this. Let's just say that you were the seller of this contract. So you're like, I think Space is going to pop off and make another run at $60. I want to sell this put. I feel like Space is not going to get below $20 by November 19th. So you sell this 20 put. You're going to collect that $100 or roughly $100 in credit or premium. And you can keep that premium no matter what happens here with Space. Space could go to the moon and go to $60, or Space could go bankrupt and go to zero. You're going to keep that credit no matter what happens here. But you're definitely open to risk here, because if Space does tank, you saw what happened if you were long that contract. It fell to 15 bucks, expiration rolls around, that contract's worth 500 bucks. So as the seller here, you're going to lose $500 minus the credit that you collected, because you get to keep that premium, or you get to keep that credit that you collected when you sold this put. So you'd be out roughly $400, a little less than 400 bucks if Space finished at $15 on expiration and you got exercised. But let's say you're right. You sold this 20 put for November 19th. You're correct in your assumption. Let's just say Space finishes at $25. It trades completely sideways until expiration. The buyer has no value in that contract. That contract's worthless. So you collected that, 107, 108 bucks, whatever it was up front. And now the contract is worthless. Bam. As a seller, you keep all that credit. The contract is worthless, and you just made over $100 on this trade. So you can kind of see, as a seller of the put option here, as a buyer of the put option, kind of how it can work out for you. How can it be profitable if I'm a buyer of a put? How can it not be profitable? How can it hurt me? How can I lose the money? And then on the selling side, same thing. How can I make money? How can I lose money? And I forgot to mention too, as the buyer of this contract, you have that defined risk. If you go out, let's just say you pay 108 bucks for this contract here, that's going to be your max risk on this trade. Because again, if Space does not go below $20 by expiration, or if it does not make a big move towards this put before expiration, and this contract becomes worthless on November 19th, you're out 108 bucks or whatever you spent on that contract. You can't lose any more than 108 bucks on the contract. So you kind of see, as the buyer, you're defining your risk here. You're not going to lose more than a certain amount. As a seller of this contract, your risk is not as defined, really. I mean, technically it's defined in a way. If Space tanked and went to zero, they went bankrupt, you're going to be out $2,000 here, because the difference between $0 and 20 is 20 times 100 shares. The contract's going to be worth $2,000 at expiration. It can fluctuate. Space can go down to 15, you're out 500 bucks. Space can go down to $10, you're out 1,000 bucks. Space can go bankrupt, go to $0, you're out $2,000. So you can kind of see, as the seller, you're opening yourself up to much more risk by selling this put. But if you look at statistics on out-of-the-money options, you'll see that most out-of-the-money options expire worthless at expiration. So your probabilities in this trade are a lot higher as a seller of this contract, but you're taking on more risk. Whereas if you're a buyer, you're taking on less risk, but your probability of, becoming profitable on this trade, it's not as high. So, I want to just kind of cover some of the basics, how, if you bought, if you sold, where it's profitable, where it's not profitable, what are the risks involved. So if you guys are trying to get into options trading and you're not too familiar with the puts and how they work, I hope this video shed a little light on that and help you to understand how the put option contracts work a little better. Please like this video. Please also subscribe to the channel. If you're not subscribed, hit that notification bell. Appreciate you guys for taking the time to watch this. Talk to you soon.